Hi, I'm Rick Kahler. Thanks for joining me. Aligning your stated values and your spending is something that I encourage as part of financial wellness, but it isn't always very easy to do. For example, someone who is strongly concerned about climate change will likely avoid buying items like bottled water, plastic bags, aerosols, chlorine bleaches, disposable cutlery. If possible, and logistically and financially, they might even drive an electric vehicle. These same people often want to invest their money in firms that have policies to protect the environment. Other investors may be especially concerned about gender and diversity, equality, fair labor practices, human rights, transparent accounting methods, integrity and diversity in the leadership, or perhaps the accountability to shareholders. This type of investment philosophy is called environmental, social, and governance investing, and the short for that is ESG. In recent years, ESG investing has really exploded. According to a Wall Street Journal editorial on September 6, 2022, more than 20 trillion is invested in ESG funds, and this accounts for 25% of all the professionally managed assets in the world. I found that stunning. On the surface, ESG investing is a pretty worthy goal and certainly in congruence with someone that holds these values. Yet it's nowhere as simple as it looks. First, there's no universal agreement about the factors of ESG investing, or what the definitions are. Each fund has its own set of criteria. Jonathan Kavasik of Cherokee Investments quoted in June 18th of 2018 in an article by Robert Powell in USA Today said, just because the fund has ESG in the title, it doesn't mean it meets your definition of ESG. So it's pretty important to become very clear about your personal views on social issues, environmental policy, and corporate governance before shopping for a fund, because there's no one size fits all. And the size you buy may absolutely not fit. Second, some ESG funds are more about greenwashing. That was a new term to me. Greenwashing is talking the talk, but not walking the walk when it comes to more green policies. So it's more about looking like we're doing it than true ESG investing. Brian Waldner, who's a Kahler Financial Group financial planner and former portfolio manager with Columbia Threadneedle, says that there's two types of firms: those that practice SRI or ESG, and those that market ESG. Third, you need to consider the potential monetary impact of owning ESG funds. While some ESG funds do a little better as far as returns than owning an index fund, in my experience, most do a little worse, largely because most have much higher fees than their passive counterparts. So you need to be ready to make that trade-off in return. Fourth, many ESG investors believe that by not owning the shares of an offensive company, they harm it by restricting its flow of capital. Now, this is just not the case. Why? The only time a company benefits financially from the sale of stock is when it goes public. This is called an initial public offering or an IPO. Or it issues additional new shares to raise capital. Now, these are really rare events in the life of a corporation. Most stocks are bought and sold in what's called the secondary market through exchanges like the New York Stock Exchange. These platforms facilitate transactions between individuals and institutions wanting to buy and sell shares in a company. The money moves between the buyer and the seller. None of it goes to the company. It's no different when a company borrows money through issuing bonds. After the initial bond issue, the bonds are bought and sold on the open market, where none of the money paid or received goes to the company. Now, it's true if no one bought a company's shares or possibly their bonds on a secondary market, but definitely their shares, its stock price would certainly plummet. And yet, this is highly unlikely because as long as the company is profitable, the demand for their shares is not going to go away, especially from the index funds or the institutional buyers. The value of investing in companies that align with your beliefs may still be worthwhile to you. Yet the most effective way to influence companies you believe to be socially irresponsible is to boycott them and the products that they sell. Refusing to purchase their products or services is going to make a much bigger impact than refusing to own their stocks. Thanks for listening.